When you look at a company's balance sheet and see that line for inventory, what do you picture? Just a bunch of stuff sitting on a shelf, right? Well, it's so much more than that. Every single item in that inventory tells a story about the company's health, its efficiency, and even its future. Today, we're going to learn how to read that story using the International Rulebook for it all, IAS 2.
So here's our game plan. We're going to follow the journey of a single inventory item, all the way from its creation to the moment it's sold. And along the way, we'll see exactly how accountants track its value every single step of the way.
Okay, let's get right into it. To understand the story, we first need to know who the main characters are. So, what does the official standard, IAS 2, actually count as inventory? Well, the standard actually breaks it down into three simple categories. Let's imagine a company that makes custom skateboards. First, you've got the finished skateboards, all shiny and ready to be sold. That's your classic inventory held for sale. Then, back in the workshop, you've got boards that are half assembled. That's what we call work in progress. And finally, you have all the parts, the raw wooden decks, the wheels, the grip tape, just waiting to be used. All three of those, yep, that's all inventory.
So now we know what it is. But what's it actually worth when a company first gets it? Well, figuring out its initial cost is a little more complex than just glancing at the price tag. IS2 tells us we need to add up three different types of costs. For a skateboard, the costs of purchase would be what we paid for the wood and the wheels, plus any shipping to get them to the factory. Then you have costs of conversion. This includes the salary of the person who actually builds the board, and even a slice of a factory's electricity bill. And finally, other costs might be something special, like the cost of a unique graphic design for a particular customer's order.
Now, here's where it gets really interesting. What you can't include. Let's say your manufacturing process is a mess and you waste a ton of wood. You can't just bake that extra cost into your inventory's value. Same goes for your marketing budget or the salaries for the folks in the head office. Those are just expenses for the month. And this is a big deal because it stops companies from hiding their operational screw-ups inside their asset values, which gives us a much clearer picture of how they're really doing.
Okay, so we've built our skateboard and we've calculated its cost. But, things change. Its value can go up or down while it's just sitting there in the storeroom. And for that, IAS2 has one crucial golden rule.
And here it is. This right here is the absolute core principle of inventory valuation. It's a rule of, let's call it prudence. It basically says, hey, don't get ahead of yourself. You can't claim your assets are worth more than what you can realistically sell them for.
That, of course, leads to the next big question, doesn't it? What in the world is this net realizable value, or NRV, anyway?
The standard is super clear about this distinction. Net realizable value is all about your company. It's what you expect to sell your specific skateboard for minus any costs to get it sold, like a salesperson's commission. Fair value, on the other hand, is all about the market. It's what anyone out there would generally pay for that type of skateboard. And believe me, those two numbers can be very, very different. So here's the bottom line. If last year's skateboard model is suddenly out of fashion and you can only sell it for less than what it cost you to make, you have to face the music. You have to recognize that loss right now. You write down the value of that inventory on your books. And this, by the way, is the accounting reason for those huge clearance sales you see. Companies are scrambling to sell that stuff before they have to write its value down even further on their financial statements. All right, let's tackle the next puzzle. What if your warehouse is full of identical items that you bought at different prices? Imagine buying skateboard decks all year. In January, they're $50, but by June, inflation bumps the price to $60. You sell one, so which cost do you use? $50 or $60? IS2 gives companies two main ways to handle this. The first is FIFO, which stands for first in, first out. It's simple. You just assume you sell your oldest stuff first. The other method is weighted average cost, which kind of smooths out those price bumps by calculating one average cost for all your identical items. And this is where the accounting choice can make a huge difference. Just look at this table. In both scenarios, we sell 12 decks. With FIFO, we say we sold the first 10 we bought for $50, plus 2 of the new ones at $60. That gives us a cost of sales of $620. But with the weighted average method, every deck has an average cost of $55. So selling 12 of them gives us a cost of sales of $660. That is a $40 difference in cost for the exact same sale. And that difference goes straight to the bottom line, directly impacting the company's reported profit.
All right, the big moment is here. We've built the skateboard, we've validated it on the shelf, and now, finally, it's sold. This is the last step of its journey in the company's books.
The moment that inventory is sold, a really important thing happens in the accounting world. The value of that skateboard literally moves. It goes from the balance sheet, where it was an asset, something the company owned, over to the income statement, where it becomes an expense called cost of sales. It is now officially the cost of making that sale.
Now, the whole point of all these rules isn't just to give accountants a headache, right? It's about giving everyone clear, consistent information. So, to wrap it all up, IAS 2 says companies have to be totally transparent about how they're handling their inventory. You can think of this as the investor's toolkit. Companies have to tell you which method they're using. Is it FIFO or weighted average? They have to show you the total value of their inventory, how much of it they expensed, and, this is a big one, the amount of any write-downs they were forced to take. All these little details let you, the person reading the financial statements, really understand how that company is managing this super important asset and how their choices are affecting their profits. So you see, inventory accounting isn't just about some dusty old rules. It's a living story about a company's efficiency, its power in the marketplace, and its ability to stay ahead of trends. It's a story of value being created, being looked after, and finally being turned into profit. So the next time you see that inventories line on a financial statement, you'll know it's not just a number. It's a story waiting to be read.